Assalamu alaikum. My name is Abdullah and my registration number is 22ME101. Today I am presenting my PLO-11 deficiency task for the course Engineering Economics. The purpose of this presentation is not only to explain engineering economics concepts but also to demonstrate how these concepts are applied in project management and engineering making. As I have done two courses of business analytics with Excel and a project initiation course, which is the first course of the certification of Google Project Management. In engineering, technical knowledge alone is not sufficient. Engineers are often required to make decision making involve investments, budgets, operating costs, and long-term financial impacts. Engineering economics provides the tools needed to make such decisions in systematic and logical manner. In addition, in addition, uh, I have completed Coursera certifications of business analytics with Excel and Google Project Initiation, which is the first course of Google Project Management certification. There are 7 courses. I have done the first course. It is the second course. Sorry. Throughout this presentation, I will relate the concepts of engineering economics with the skills and knowledge gained from these courses. The combination of engineering economics and project management enables engineers to evaluate alternatives, analyze risk, and select the most beautiful project for an organization. Now heading to slide 2. I have divided this presentation into 4 CLOs. The first section focuses on discounted cash flow analysis and the time value of money. The second section covers capital recovery, net present value, and rate of return analysis. The third section focuses on life cycle costing and financial valuation of engineering alternatives. Finally, the fourth section presents a practical engineering case study where these concepts are applied to real-world decision-making problems. These topics are highly relevant to project management because before any project begins, manager must evaluate whether the project is financially feasible and economically justified. In the Google Project Initiation course, one of the first steps is determining whether a project should move forward. Engineering economics provide the financial tools needed to make that decision. Similarly, business analytics with Excel teaches how to analyze data and transform numbers into useful information. Engineering economics relies heavily on same analytical approach. The first CL is express knowledge and skills to solve engineering economics method by discount flow method. As I have told you that the first the first was selected CLO was on discounted cash flow. Here I will explain you about time value of money, how to use P by A factors and P by F factors, interest rate types, equivalence concept, why it matters in engineering decision. So discounted cash flow. Before solving economics problem, we first need to understand discounted cash flow, commonly known as DCF. The basic idea behind DCF is the concept known as time value of money. This happens because today because this happen because today money can be invested and earn interest, and because inflation reduces purchasing power over time. The formula shown on the slides, like this, I have the formula shown here. Present value, where FPV is present value, F is future value, I is interest rate, and N is number of periods. For example, if someone offers me 10,000 rupees today or 10,000 rupees after 5 years, most people would choose the money today because it would be invested immediately. This concept forms the foundation of engineering economics and project evaluation. In business analytics with Excel, similar calculations are performed using spreadsheet functions to evaluate investments and future returns. Now heading to slide 4, a common question is why we cannot simply add future cash flow together without any adjustment. Money has different values at different times, as I have given a previous example. The answer is that money has not the same values across time. Inflation risk and investment opportunities all affect the value of money. For example, 10 years ago, many products could be purchased at much lower prices than today. Therefore, certain amount of money in the future does therefore certain amount of the money in the future uh, have does not have the same purchasing power as the same amount today. The interest rates acts as an adjustment factor that converts future money into value. Let us consider the example shown on slide. Using a discount rate of 10%, the present value becomes approximately 37,000 rupees. This means that receiving 60,000 rupees after 50,000 is economically equivalent to receiving approximately 37,000 rupees today. Since 50,000 rupees today is worth more than 37,000 rupees, it is the better choice. Project manager use this type of analysis frequently when evaluating future project benefits. A project may promise large future savings, but those savings must be first added into present value before making a decision. Now, fifth slide. In my engineering, in many engineering projects, the same amount of money is received or spent every year. Example include annual maintenance costs, yearly operating expenses, rental payments, or annual revenues. When cash flows are equal every year, we call them uniform cash flows or annuities. Instead of calculating the present value of each payment, separating engineering economists use the present worth factor, commonly called the P over A factor, which I have shown you on the previous slide. This formula specifies calculation and saves time. The variables shown in the formula include the annual amount, interest rate, and number of years, and project life number of years. For example, suppose a machine it required 10,000 rupees of maintenance every year for 10 years. Instead of discounting 10 separate cash values, we can use the P over A factor to find the total present worth directly. Now slide 6. Although the P over A factor is useful, it can only be applied when annual cash flows are equal. P by A factor assumes equal payments every year, annuity. Many real engineering projects do not have perfectly cash flows. Maintenance costs may increase over time. Maintenance costs of, for example, in industries there are machines, they require maintenance. Production output every year. Revenue may fluctuate depending on market conditions, inflations. In such cases, using the P over A factor would lead to inaccurate results. This highlights an important lesson for engineers project managers. Before applying calculation method, we must first understand the nature of data. One key idea taught in business analytics with Excel is selecting the appropriate analytical tool based on the characteristics of data. The same principle applies here. Using the correct economics factor ensure reliability. Now slide 7. Here are shown two figures of uniform and non-uniform cash flow series. The left is of non-uniform cash flow and the right is of non-uniform cash flow. Uniform cash flow consists of equal payments or receipts occurring at regular intervals. Like in left there are all regular intervals. Example include annual salaries, rental payments or fixed maintenance contracts. Non-uniform cash flow on the other hand vary from year to year. Examples include project revenues that grow. Recognizing the type of cash flow is very important because it determines uh, because it determines which economic analytic technique should be used. Actually, this process is very similar to the data classification in business analytics, where data must be first understood before analysis begins. Now, next slide. In this, I will discuss about nominal and effective interest rate. Nominal interest rate, another important concept is in engineering economics. The nominal interest rate is the rate stated by bank or financial institution. However, it does not account for compounding. The effective interest rate considers how many times interest is compounded during the year. Because of compounding, the interest rate is usually higher than the nominal rate. In the example shown, a nominal rate of 12% compounded quarterly result in an effective annual rate of approximately 12.57%, as it is shown in the nominal rate, where I have given an example of 12% compound quarterly per year. Understanding the difference is important because project evaluations can change significantly when compounding is considered. Project manager must ensure that correct interest rate is used in financial analysis. Equivalent value of today, equivalent value today of single future sum. Suppose we are expecting to receive a certain amount of money in future. How can we determine its value today? The first step is identifying the future amount. The second step is determining the discount rate, appropriate discount rate. The third is determining number of years involved. And finally, we have to apply the present value formula to calculate the equivalent value of today. This process allows engineer to compare future benefits with present costs without discounting. Project evaluations could be misleading. Discounting is one of the most fundamental tools uh, in engineering economics and project finance. Key variables influencing the result. The present value of future money depends mainly on three different variables: future value itself, interest rate, and the number of periods. If the future value increase, the present value also increase. If interest rate increase, the present value will decrease. If the time period become longer, the present value will also definitely decrease. Understanding these relationships helps engineers predict how financial decisions will be affected by change in project assumptions. Sensitivity to these variables is an important aspect of project planning and risk assessment. Now the seventh slide of my CLO1, concept of equivalence in ECM. Two cash flows patterns are considered equivalent if they have the same value at the specific point in time. Although two alternatives may be different on timeline, they may be equivalent after discounting. In project management, different investment options often have different payment schedules. Before making a decision, all cash flows must be converted to common basics. This ensures that decisions on the base of the are on the base of objective financial analysis rather than appearances. It matters because, as discussed in previous slide, the engineering project cost and benefits happen at different times. To make a fair decision, we must bring all cash flows to the same time. For example, I have written in slide. This example demonstrates the concept of equivalence using actual numbers. One of the option 1 consists of multiple cash flows occurring at different times. Option 2 consists of single lump sum payment today, like option 2 of PKR 18,500 rupees. At a first glance, these alternatives appear completely different. However, after converting the future cash flows into present value, we find that they are nearly equivalent. This example shows why engineering economics is essential for decision making. Without present worth analysis, we might incorrectly assume that one option is significantly better than the other. Now, the CLO2, CLO1 was about all the discounts rate and the inflations. Now the CLO2, which is about mainly about the net present value, return on investment and computational capital recovery. This learning outcome focuses on capital recovery, net present value, and a rate of return analysis. These tools are among these tools are among in engineering economics and present and project management. Organizations use this method to determine whether the project may be accepted, rejected, or prioritized. In Google Project Initiation course, project approval decisions are based on feasibility, benefits, cost, and expected outcomes. Engineering economics provide the quantitative tools required to perform the evaluations. Now the next slide is of capital recovery. Capital recovery represents the annual amount required to recover an investment over its useful life. It converts large initial values into its useful life uh, into its into an equivalent yearly costs. This help organization how much a project must earn annually to justify the assessment investment. Uh, this formula shows the formula show in slide include the initial cost, salvage value, interest rate, and a project life. Capital recovery is commonly used when comparing equipment alternatives. For example, if two machines have different purchase prices and useful lives, capital recovery converts both of its annual values for easier comparison. This makes decision making more objective and practical. Now, the 15th slide is of M, minimum acceptable rate of return and capital recovery. It represents the minimum return that the organization expects from an investment. The choice of MARR has a direct impact on capital recovery calculations. As the required rate of return increases, the annual capital recovery amount will also definitely increase. In project management, minimum acceptable rate of return serve as a financial benchmark during project selection. It helps organization allocate the resources to projects that provide sufficient value aligned with business analytics. Now the next slide is of net present value. The previous was of MAR and capital recovery. Net present value is one of the most important tools in engineering economics and project management. NPV represents the difference between present value of all benefits and present value of all costs associated with the project. The decision rule is simple. If NPV is greater than 0, the project is economically acceptable because it generates value beyond the required return. If the NPV is less than 0, uh, the project should be rejected because it does not meet the organization financial expectations. For mutually exclusive projects, we select the alternative with the highest NPV. In the Google Project Initiation course, project selection is based on value creation and business benefits. NPV provides a quantitative way to measure that value. This is why NPV is widely used in industries when making investment decisions. The example is shown. The basic idea is to compare all future inflows and outflows after converting them into present value. By discounting future cash flows, we ensure that all values are compared on same basis. This allowed decision makers to understand whether a project will create value over its life cycle. In business analytics with Excel, spreadsheet models are often used to calculate NPV for different scenarios and compare project alternatives. This analytical approach helps manager make data-driven decisions rather than relying on assumptions. Rate of return or IRR. Another important financial evaluation technique is rate of return. The interest rate at which the net present value of the project becomes zero is IRR. In simple words, it represents the actual meaning earning power of an investment. The decision rule is straightforward. If the IRR is greater than MARR, minimum acceptable rate of return, the project is accepted. If IRR is lower than MARR, the project is rejected. Project managers often use IRR because it expresses project performance as a percentage and communicate. Percentage making it easy to understand. Now, pitfall of using ROR with non-conventional cash flows. Although IRR is a useful technique, it has some limitations. One of the major issue occurs when cash flows change signs multiple times throughout the project life. In such cases, multiple IRR values may exist. This creates confusion because more than one interest rate satisfy the NPV equation. Therefore, engineers should not rely solely on IRR. Instead, it should be used together with the method of NPV. This highlights the understanding of the strength and weaknesses of different analytics tool before making project decisions. Method to solve are Nostrom's criteria and Distler's rule of signs. IRR for independent and mutually exclusive projects. Independent and mutually exclusive. The application of IRR depends on the type of project being analyzed. For independent projects, all projects with IRR greater than MARR can be accepted because they do not compare with each other. For mutually exclusive projects, one of the alternative can be selected. In such cases, we compare alternatives and choose the best option. Project manager face this situation frequently when deciding between the situation frequently when deciding different technology equipments or production methods. Engineering economics provide the framework needed for these comparisons. Now the slide number 21, sorry. IRR for the I have shown you the example of IRR with an independent project. This example demonstrates the use of IRR. The project requires investment for $20,000 and generates annual income over 3 years. The resulting IRR is approximately 18.2%. Such this value is greater than the company's MAR of 15%. The project is accepted. This example also demonstrates how spreadsheet tools learned in business analytics with Excel can simplify financial analysis and improve decision making. IRR for mutually exclusive projects. I have drawn a table in the slide. This slide introduces comparison between two alternatives. The first alternative is sorry. The first alternating is continuing with the manual production line. The second alternative involves investing in the robotic arms. Since one alternative can be selected, the purpose of analysis is to determine uh, which option which option is better economic performance. This is the incremental analysis for mutually exclusive projects. When comparing mutually exclusive alternatives, incremental analysis becomes important. Instead of evaluating such projects, the difference between the alternatives, the difference between the alternatives we analyze the difference between the alternatives. This helps determine whether the additional investment required for the expensive option is justified. Incremental analysis is considered a more reliable approach for company mutually exclusive projects. Project managers often use this technique when evaluating technology upgrades and automation projects. IRR for mutually exclusive projects break-even points. This slide shows the break-even IRR between the two alternatives. The calculated IRR is approximately 38%. Since the value is significantly greater than MAR, the robotic arm alternative becomes the preferred option. I have two slides before. This means that additional investment in automation generates sufficient benefits to justify its cost. Such analysis help organization invest confidentially in the technologies that improve productivity and efficiency. Comparing projects with different lives. A common challenge in engineering economics occurs when projects have different useful lives. Direct comparison may lead to misleading conclusions. To solve this problem, we use methods such as LCM or an annual worth analysis. This, this method creates a fair basis for comparison. In project management, decision makers frequently encounter alternatives with different service lives. Therefore, understanding how to compare such projects is essential for making a most economical option, for deciding a most economical option. Now the slide 26 of CLO3. Uh, here I will introduce move here I will move to CLO3. That this learning outcome focuses on life cycle, costing and financial evaluation. Instead of focusing only on the purchase price, it includes operating costs, maintenance costs, replacement costs, and disposal costs. This approach provides a more realistic assessment of project economics. Many organizations use life cycle costing because it supports sustainable and long-term decision making. Comparing two designs scenario. This is an example I have right in slide. One design has a lower initial cost but higher maintenance expenses, and the second design has high initial cost but low maintenance. Here we have to use the yes, PW if analysis period is fixed. The other engineering economics help determine which design is truly more economical over the project life. This demonstrates why project managers should not focus solely on the initial cost when making investment decisions. At low purchase price does not always result in lower costs. So design B is more economical. Unequal lives. When alternatives have unequal lives, direct comparison may be difficult. One alternative may operate for 5 years, while the other make while the other operates for 10 years. The longer life alternative naturally accumulates more benefits. To ensure fairness, we use techniques such as annual worth analysis. This converts all alternatives into equivalent annual values. Project managers use these techniques to compare projects objectively and avoid based on decisions. Why present worth is biased if lives differ? Why? Present worth can become biased when project lives different significantly. A longer project may appear more attractive simply because it lasts longer. However, this does not necessarily mean it is economical, economically superior. Therefore, additional methods such as annual worth and repeat cycle analysis are required. This technique ensures that comparisons remain fair and meaningful. Understanding these limitations improve the quality of evaluations. If two projects have different lifespans, you're not comparing the apples to the apples. One project might last 5 years and the other 10 years. Non-monetary qualitative factors in financial evaluation. Financial analysis alone is not sufficient for making project decisions. Engineers must also consider environmental impact, work safety, and social acceptance. Also, the main sustainability. A project may appear profitable but still may be rejected if it creates significant environmental or social problems. This concept is closely related to modern project management practices where stakeholder interests are considered alongside financial performance. Responsible engineering requires balancing profitability with ethical considerations. Break-even analysis. Break-even analysis helps determine the point at which two alternatives have equal costs. This technique is particularly useful when comparing equipment with different purchase and operating costs. For example, one machine have a higher purchase but low operating cost and the second machine have low purchase price but higher operating cost. Break-even analysis identify the usage level at which one alternative becomes more economical than the other. This helps manager make informed investment decisions. Break-even analysis. Break-even analysis help determine the point at which two alternatives have different equal cost. Sorry, I have explained that, but due to some video issue, I have added mistakenly this portion. Now, going to the simple calculation of break-even analysis. This procedure for break-even analysis is relatively very simple. First, we develop a total cost equation for each alternative. Next, we set the equation equal to each other. Finally, we solve for the unknown variables such as operating hours or production quantity. The results represent the break-even point. Business analytics with Excel provide useful tools for performing this type of analysis and visualizing the results. Now the CLO4 has started. I will discuss about the focus on applying engineering economics to real world engineering problem. This was the CLO4 developing economic solution for real life situations. The case study involved deciding whether continue whether to continue using manually assembly line or invest in robotic automation. This is an excellent example of project initiation because management must determine whether the investment is financially justified. The analysis combine engineering economics, project management, and business analytics concepts. Now the key economic factors. These include purchasing cost, operating cost, depreciation and taxes, salvage value of the old machine, useful life of the both machine, production improvements with the new machine, and more. A comprehensive valuation requires consideration of all these variables. This systematic approach reflects the project planning is taught in the course of Google Project Management. Methodology. This slide outlines the methodology used in the analysis. The process begins with the cost estimation and continues through depreciation, taxation, cash flow analysis, rate of return evaluation, sensitivity analysis, and final recommendation. A structured methodology ensures that no important factors is overlooked. Project managers frequently use similar frameworks when evaluating major investments. Cost distribution. This slide shows the cost distribution for the two alternatives. Understanding Cost distribution helps identify major cost contributors and areas where savings are achieved. Cost estimation is a critical step in the project planning because inaccurate estimates lead to poor investment decisions. Business analytics techniques can be used to organize and analyze these cost components effectively. Here is the second one, where the initial investment, annual recurring cost, labor cost, intangible hidden cost, and end of the life disposals both are shown. Now depreciation for the cost of alternative B. Depreciation allocates depreciation allocate the cost of the cost of asset over its useful life. Although depreciation is non-cash expense, it significantly affects taxes and after-tax cash flow. The MACRS method shown here is commonly used for financial analysis. Understanding depreciation is essential because tax savings can sustainably influence project profitability. The second is the depreciation formula: initial cost minus salvage value over useful life. The depreciation is 11,000 for $29. This was for an alternative A, which I have given the alternative B and A both. The CFAT analysis for alternative B. There are shown two, and for alternative B I have in table. CFAT represent the actual cash available after accounting for taxes. Since taxes affect the project profitability, after tax analysis provides more realistic calculations than before tax analysis. Managers rely on after tax cash flows when making financial decisions because they reflect the true economic impact of project. Incremental cash flow. Incremental cash flow analysis, which is the uh, incremental cash flow analysis, focuses on difference between two comparing alternatives, that the depreciation of alternative A and B shown on the previous slides. Rather than evaluating each alternative independently, we examine the additional costs. And benefits associated with selecting one option over the other. This provides this approach is particularly useful when comparing mutually exclusive projects. The alternative A and B was both the mutually exclusive projects. It ensures that decisions are based on relevant financial differences. The present worth of incremental CFAT. These and at different interest rates, and these two slides and this graph represents how present worth changes at different interest rates. As you There is a below curve, down curve. Interest rate is one of the most influential variables in project evaluation. A change in interest rate can significantly affect project attractiveness. Analyzing different rates help decision makers understand project sensitivity and financial risk. This type of analysis is widely used in project planning and investment evaluation. Now the slide 45. Present worth of the both alternatives shown from the slide 39. Uh, Here I have compared the present worth of both alternatives. Present values convert all the cash flows into today value, making comparison straightforward. The alternatives with high present worth provide a greater economic benefit. This information forms the basis for the final recommendation. Sensitivity analysis. Sensitivity analysis evaluates how project results change when assumptions are modified. Since future conditions are uncertain, it is important to understand how sensitive the project is to key variables. This helps manager identify risks and prepare for different scenarios. Sensitivity analysis is one of the most valuable decision support tools in both engineering economics and project management. Here, the alternative B has the operating cost of $40,000, which is much more greater than the alternative A. As even small changes in operating cost can greatly affect profitability, especially in high expense systems. Uh, Now sensitivity analysis variation in present worth with operating cost. Here is a graph which are the of the both alternatives A and B. By varying operating cost, we can observe how project profitability changes. This helps determine whether the project remains economically very viable under different conditions. Business emphasizes this type of scenario analysis because it improves decision quality and reduces uncertainty. Final recommendation. Based on all the analysis performed, the robotic arm alternative is recommended. It provides a higher present worth and better long-term financial performance. In addition, it improves efficiency and productivity. The recommendation is supported by quantitative analysis rather than assumptions. This demonstrates the value of engineering economics in project selection and strategic decision making. The robotic arm was higher long-term savings and efficiency but also favorable depreciation of 7-year MACRS classes and better tax treatment with a present worth of $672,317.44. Balancing economics and ethics. Engineers must profitability. Engineer must balance profitability with ethical responsibility. A project should not be selected solely because it generates financial benefits. Environmental impact, worker safety, sustainability, and social welfare must also be considered. Responsible engineering decision making responsible engineering decisions create value while protecting people and the environment. This principle is strongly emphasized in modern project management. How to decide? List advantages and disadvantages of each option. Think about long-term effects on society and nature. Then use tools like environmental score. Sustainability is the most important factor in engineering. How these case study of the two alternatives I have shown you about the depreciation, net present value, operating cost of the both alternative or robotic arm is related to the courses I have done through Coursera. The concept used throughout is closely related to my certifications in a way that business analytics with Excel, which I have also done an assignment, helped me understanding data analytics, spreadsheets, modeling, scenario evaluation, and financial decision making. Project initiation taught me how projects are evaluated, prioritized, and approved, and checking their feasibility. The combination of these skills spotted in engineering economics analysis present in the case study. To learn how classify and analyze different types of uh, cost, fixed and variable cost for effective control and management. This study also aligns with the objectives of cost accounting and business decision making. The analysis required cost estimation, tax evaluation, taxes, depreciation, break-even, and return on investment analysis and sensitivity analysis. These are the key contents that are related to the two courses I have done with the help of Coursera. References. These are the references used in developing this presentation. The primary source was Engineering Economics by Blank and Turkin, which provided a theoretical foundation for concepts discussed, Additional references were used for supporting information regarding depreciation methods and financial analysis. Using credible references ensures accuracy and reliability in engineering decision making. Now, thank you. Through this presentation, I demonstrated the application of engineering economic tools in project evaluation, investment analysis, and decision making. I also showed how the knowledge gained from the business analytics with Excel and Google project management support project planning, feasibility assessment, and project selection. Together, these disciplines help engineers make informed, responsible, make these disciplines help engineer to make informed, responsible, and economically sound decisions. Thank you very much for your time and attention. I will be happy to answer any of the questions, sir. Thank you.